Hello, everybody. Welcome to our year-end tax planning for investor seminar presented by me, Scott Schomer. This is my very first webinar, so thank you for participating, and hopefully this will go smoothly. I've never done one of these before, so we're excited to have you here today. Thanks for joining us. So today's agenda is relatively straightforward. We're going to cover an economic and market update. We're going to review some year-end tax planning and strategies, and we'll take a little time for your questions and answers. Now, during the presentation, I'm going to probably talk about some examples, some hypotheticals. These are meant for illustrative purposes, and your situation may be different and may not apply directly. The best thing to do is to sit down with us or a tax advisor and review these things in more detail and see if it's appropriate for you. So with that, let's get started. So before we delve into this, we are financial planners, and it's always important to focus and think about the 5 key areas of financial planning. Number 1, we're looking at preservation. Number 2 is we're looking at retirement planning. Number 3 is we're looking at your investments. Those are absolutely critical. Number 4 is we're looking at your silent partner or not so silent partner, the U.S. and California governments, or tax planning. And then finally, what we consider the most critical is we're looking at your estate planning. As a comprehensive financial firm, we always try to keep all of these issues in mind when we're advising clients. And we think it's our competitive advantage over most people that advise in this area. So assessing your financial situation now and discussing potential year-end strategies can help reaffirm your overall financial plan and also save you from all kinds of costly mistakes. We regularly encounter clients who have not taken the time to spend a little review and analysis of their plans to make sure that everything is working, both from an estate planning perspective and a tax planning perspective and an investment perspective. So there's nothing like a little time to spend reviewing these issues, and we're glad to help our clients. Now, if you've been following the news, you know that 2019, like 2018, has been a volatile year for investors. We've had some mildly dramatic movement in the market. There's been a slowing of the global economy, continued trade wars and tariffs. There's been some sluggish corporate earnings, and also there's been some historic lowering of interest rates, something that we've not seen since the days of the Great Recession back in 2008. All of these have made the market a little skittish and contributed to the volatility in the market. But before we think about this as all being doom and gloom, remember that volatility has 2 sides to it. And one of the most important things to keep as a perspective when you're investing is the long-term gain. Equities are our best friend. Equities are stock. They are one of the greatest wealth creation tools ever invented. And a good perspective is illustrated by the performance of the S&P 500 just over the last 70 years or 69 years since the 1950s. And you can see that if you've been in the market, you've been able to reap some dramatic increases in the value of your portfolio. But if we take a much shorter time period, since October of 2018, you can see that increased appreciation comes with some volatility and some fear factor, the roller coaster we call this sometimes. Since October 2018, there have been four downswings. The first one was at the end of the year last year of 2018. That was our most dramatic drop. There was another one that occurred this past summer. You may not have even noticed it in May and June of 2018. Next up is we had a drop in August, just this past August and September. And then finally, we also had our first indication back in November. We've been having a booming year up through 2018, up through November, and then we all got a little reminder of reality. So the important thing to remember is that volatility is part of investing. Volatility is our friend when equities move in a positive volatile direction. That's called investment return. It's the downside that we get nervous about. And volatility can function in either direction. The market generally gets labeled as being volatile when there's a rise or fall of more than 1% over a sustained period of time. So the important thing to remember is that volatility should not be confused with market risk. Market risk is defined as the possibility of an investor experiencing permanent losses due to factors that affect overall performance of the financial markets in which he or she is involved. So how do you react to this? How do you deal with volatile markets? Well, there's some things to keep in mind. First of all, you need to be an optimist. Take the long view. Look at what equities have done for investors over the past 70 years. Keep that in perspective when you watch the day-to-day movements. Second, try to avoid making emotional decisions. It's some of the worst things you can do is buy or sell simply on a hunch. Remember that you're in there for the long term. That's what the disciplined investor does. Third, be very aware of media magnification. The old saying goes that if it bleeds, it leads. In other words, if there's bad news out there, they want to broadcast it from the highest mountaintop. They want to tell you everything that's going wrong in the world. Don't listen to the hype. Stay true to your values. When there's some volatility, this is a good time to recheck your risk tolerance. Are you really prepared for the types of drops in your portfolio based on your risk tolerance and also your time horizons? Has anything changed? When you encounter volatility, it's a good time to make sure that you're in for a certain period of time. And finally, focus on your goals. What are your goals with investing? Are you saving to have income during retirement? Are you saving, investing for your loved ones, for your children, for your grandchildren? What's your time horizon? And always consult with your financial advisor for an objective viewpoint before making any significant changes. So one of the things that's happened in the past year, you're probably aware, is the Federal Reserve has taken some action in the last 6 months with regard to interest rate. There have actually been 3 revisions to the Federal Reserve window rate, as they call it. The most recent change just happened last month in October. With soft economic data and continued trade wars, analysts are predicting that the Fed may even lower interest rates further, although nobody has a crystal ball and nobody can tell you for sure what's going to happen with the interest rates. Federal Reserve Chairman Jerome Powell recently stated, quote, "What we're seeing is that it's an appropriate time to adjust policy to a somewhat more accommodative stance over time, and that's how we're looking at it." So you want to keep an eye on this stuff, realizing that nobody has a crystal ball. But with this type of change in the marketplace, with the first time we're having adjustments in interest rates since 2008, this is a good time to make sure you're comfortable with your time horizon. Also look at the amount of liquidity that you have in your portfolio. Do you have a 6-month reserve? Do you deal with any unexpected contingencies? What about the duration of your bond holdings? Consider shorter term yields over higher yields. And as always, the cardinal rule is to diversify, diversify, diversify. Just like they say with real estate, location, location, location. With investing, we want to diversify. Now, one of the other things that may have crossed your path this year is something called the inverted yield curve. If you're not familiar with this concept, this is a chart that lays out the yield curve on 2-year Treasury notes versus 10-year Treasury bonds. And in January, we had a positive yield curve, but by August, the yield curve on 10-year issues fell to or below the return on 10-year curves. So in other words, the market was saying that you were not going to get any rewarded for having your money locked up for a period as long as 10 years. So why is this an issue? And it seems a little abstract. What are we worried about? Well, this has historically been a sign of trouble. It's an indicator that a recession is looming. And in fact, an inverted yield curve has preceded each of the past 7 recessions, including the most recent one that occurred back in between 2007 and 2009. This may or may not happen. There are good arguments on both sides of the fences, but it's something to keep in mind and think about as you're moving forward. Which then gets us to the R word, recession. So when we bring up the topic of recession, close your eyes for a second and ask yourself, what does that make you think of? What comes to your mind? Is it something like this? This comes to a lot of people's minds. But one of the things that you need to realize is that, like life and death, recession is a natural part of the business cycle. What is the business cycle? The business cycle is the movement of up and downward movements in the gross domestic product of the United States. It refers to periods of expansion and contraction in the economy over several months or several years. The business cycle basically consists of 4 parts: expansion, the peak, contraction, and the trough. This is part of a normal business cycle, and it repeats continually, or at least has repeated during our history. When we get to the contraction part, we are looking at the potential of a recession. A recession is defined as a decline in the country's gross domestic product, the GDP, for 2 or more consecutive quarters in a year. If the recession goes on longer than that, then we are at risk of it becoming a depression. Now, interestingly, the term depression was coined by our former president, Herbert Hoover. Previously, extended recessions were referred to in the financial press as panics. And Herbert Hoover thought that the term depression was a milder way, or a more politically correct way, maybe in today's parlance, to describe a panic that was occurring in the market. Overall, I have to say I agree with him, although Herbert Hoover has been tagged with the Great Depression and all the negative connotation and baggage that comes with that. But essentially, depression is nothing other than an extended recession. So while we all have a fear of recession, as I indicated, this is a normal part of the business cycle. And in fact, there have been 5 recessions since World War II alone. Just briefly, if we review, in 73 to 75, we had the recession that was attributed to the oil embargo by the Middle Eastern countries. In 1981 and 1982, which was the start of the Reagan administration, we had a recession that was attributed to inflation left over from the Carter presidency and the rising gas prices. A decade later, in 1991, we had another recession. This one was attributed to the first Iraq War and also the resulting gas prices that occurred because of the Iraq War taking available gasoline offline. Another decade later, we had 9/11, and also followed quickly on the heels of the dot-com bubble. That was the great rise in tech and internet stocks, which crashed unexpectedly or precipitously. And then finally, we had the Great Recession, as it's referred to, the recession that occurred in 2007 through 2009. The attributable cause to that, it's been blamed on subprime lending, the mortgage crisis in that area, and then also, of course, our old friend, high gas prices. So that's a number of recessions for the last in the last 5 years. And why do we get concerned about a recession? Well, as an investor, recessions are correlated with corrections and bear markets. So by definition, a correction is traditionally defined as at least a 10% decline from a recent market high, and a bear market representing a minimum 20% pull down or pull back or decline from a market decline. So here's the thing that's kind of interesting. We don't necessarily have to be worried about recessions or depressions alone. The reality is that if you are investing in equities, since 1950, the S&P 500 index, which is a broad measure of US stocks, has undergone 37 separate market corrections of at least 10%. That doesn't include the rounding errors. There's been a number of them that have had declines of 9.5% and 9.9%. But we've had at least 37 that have had hit 10% or exceeded it. So considering that period between 1950 and today is only 69 years, what that means is that we're having a stock market correction on an average of 1.87 years, or almost every 2 years we're having a correction on the stock market. This again goes with the territory. With reward comes some level of risk. The issue really is how we manage it. So other concerns that we have as we review the equity markets and as we look at what's going on in the future include tariffs, political uncertainty, and global financial issues. Tariff issues under President Trump have included longtime partners including Mexico, Canada, the European Union, and China. The uncertainty in these areas have left a number of investors concerned, and this has made the equity market skittish and caused people to have more concern about it. Next up is in political uncertainty, with the impeachment hearings or inquiry just starting yesterday. You know that a number of people believe that this could have an impact on the stock market. This also caused investors to have some concerns. And then finally, we have global financial issues as well. There's a number of countries that are struggling, including Turkey, for example, they are going through some very difficult financial times at the moment. So when we review investment holdings, we look at all these issues to manage risk and help our clients evaluate if they are properly diversified and are bracing and minimizing the risks compared to their level of return. Which brings us to the issue of rebalancing. Volatility gives us an opportunity and a good chance to consider the idea that it may be a good time to rebalance your portfolio. Most investors that are disciplined are going to enter into investment based on their time horizon and based on a set fixture of how much exposure they want to equities. In other words, how much of the portfolio they're willing to expose. Has the volatility in the market put this percentage allocation out of whack? And is it a good time to readjust? Rebalancing is the process of buying and selling portions of your portfolio in order to return to your original targeted allocations. Remember, part of what we're trying to do with this process is minimize losses, which can be painful. While gains are enjoyable and a 1% loss can be offset with 1% gain, as these figures get bigger, it's harder to recover from some of these losses. So it often takes, it does take a 25% gain to recover from a 20% loss, whereas it takes 100% gain in an equity to recover for a 50% loss. So matching your investments to your risk tolerance is always the best way for any disciplined investor to go. So when you're looking at rebalancing your portfolio, we want to focus again on the long term. We want to look at recording your losses so that we know what's going on. Comparing your performance based on a future date, adjusting to changes that make sense, and always using professional guidance to help you determine the best strategy. And one of the things that we're looking to avoid in all this situation is chasing investment returns. When the markets get volatile, when the markets gets tough, it's always tempting to look around and say, where are the best investment returns? But often, this is sometimes referred to as chasing market returns or chasing track record investing, trying to invest in the things that have been the best returns in the recent past. But often the things that have delivered the best returns in the past do not correlate with what's going to deliver the best returns in the future. We also want to avoid the temptation of emotional investing. You don't want to dump something simply because you don't like what's emotionally what's going on. you want to take a real disciplined, scientific approach to it. You want to focus on your personal goals. So those are some of the things that are going on in both the equity and the financial markets, the bond markets. Let's shift our focus now to talk about some of the changes that are coming up in taxation in the years to come. First up is for 2019, we're going to have a new tax form, a new 1040. The most notable change is the signature box now appears on page 2 of the form, and there's places to enter the names of your spouses and children. The question concerning healthcare coverage has been removed because this was eliminated as a requirement. And there are now also separate lines for the earned income tax credit, additional child tax credit, and for the American Opportunity Credit. With 2019, we have some new tax brackets that are being adjusted for inflation. And we have a comparison chart to show you where things are going. You're in the 10% bracket up to 9,700 for an individual and 19,400 for an individual, and you can see where you fall on that scale. They've all been adjusted for inflation. So what about tax planning opportunities? Well, the big categories that we see in this area are tax harvesting, both gains and losses, retirement planning funding, and gifting. So let's take harvesting gains and losses first. So what is tax harvesting? Well, loss harvesting is a situation where you sell assets with long-term capital gains to be able to take advantage of lower tax brackets. Often one of the things that we do is we will repurchase the same or similar assets if you would have otherwise done it. The question becomes, where does your income fall, and are you able to take advantage of a lower tax bracket, or even eliminate long-term capital gains, and or use some of these losses to offset potential gains that you have? When you deal with these issues, you always have to be sensitive to the wash sale rule. And basically what this provides is that if you buy a stock of a similar company within 30 days, the IRS can disallow the tax harvesting. So we always want to be careful and sensitive to this, even if it's not the same stock. So the example that we use here is Coke versus Pepsi, a classic business rivalry if we've ever seen one. So a taxpayer might have a bunch of stock in Coke with unrealized losses. So you want to sell those to offset any gains that you've had in your portfolio. And then you want to go out and buy Pepsi because maybe you think Pepsi is the better investment. You've switched your drinking and now you're going to switch your shareholding to that. The issue with this is you want to be careful that we're not buying these two stocks within 31 days of each other, because what can end up happening is you can end up losing this tax advantage. So that's a great thing to consider. Retirement plan funding is another opportunity that we're looking at year end. For most investors, we really want to look at maxing out your retirement planning contributions. So the limit for 2019 is it's going to go up to $19,000 on your 401k and $6,000 for your IRA. But we also want to look at Roth IRAs for both contributions and conversions. So first up, let's talk a little bit about Roth conversions. What are the benefits of Roth conversions? So if you're not familiar with a Roth IRA is an IRA that allows you to fund it, and once you have assets inside of the Roth IRA, they are never again subject to income taxation. That's very different from a traditional IRA or a 401k, where the government is a partner. The government's going to take a tax hit from your withdrawals when you get around to withdrawing that money from a traditional IRA or 401k. The government has made a bargain with us. They said they will never ask for taxation for any money that's inside of a Roth IRA. So that's a fabulous benefit. It lowers long-term taxable income. It allows for tax-free compounding. And here's one of the best benefits is that there are no RMDs or required minimum distributions. If you are over the age of 70 and a half and have tax-deferred accounts, you're probably feeling the pain of the forced RMDs, forced taxable income, and that amount increasing every year. The benefits with the Roth is you never have to deal with these. And also your beneficiaries get tax-free withdrawals. That's a wonderful benefit. Now the Roth is only available to you as an investor if your adjusted gross income is $137,000 or less if you're single, or $203,000 if you are married filing jointly. However, every investor can take a traditional IRA and convert it into a Roth and receive these wonderful benefits. If you are dealing with this, if you're looking at converting a traditional IRA or a 401k into a Roth IRA, here are some of the things that we want to consider. What's the tax rate differential? In other words, are you in a high tax bracket today versus when you anticipate withdrawing from the IRA? That could have an impact. Do you have the ability to pay the taxation from a conversion with outside assets? Part of our goal is we want to maximize the amount of money that stays inside the IRA structure. So if you can use funds outside of your IRA to pay the taxes on this conversion, it's a wonderful, wonderful benefit. And also the time horizon, do you need this money to meet your annual living expenses, or can you defer it? These are all things that go into the factor for consider when you're looking at a successful Roth conversion. And of course, just a quick review. Here are your contribution limits for your IRA, your 403B, your 401k, your simple IRA. Remember also, you'll see they're all being raised, but also remember that if you are over the age of 50, IRS allows you to make additional contributions to catch up, so you can put additional funds into these tax deferred accounts. Gifting. Gifting is our next topic. One of the things that many people are surprised to learn is that the IRS looks at any gift that you give as potentially taxable to you as the gifter. And there are lifetime limits on how much gifting that you can do. So the first change we have for 19 is they're going to be raising the annual exclusion gifting up to $15,000. So that's on a per person, per gift basis. So if you're a single grandparent and you have 5 grandchildren, you can give each of them $15,000, and none of that has to be reported to the IRS, and none of it goes against your lifetime exclusion. 529 plans. These are essentially tax-deferred investment accounts for children to be used for educational expenses. One of the great gifts that you have is that we can actually front-load the funding of a 529 plan and fund as much as $75,000 without incurring gift tax liability. You can spread it out over 5 years. You can take that $15,000 a year per year exclusion. The $75,000 gets funded into the 529 plan, and can then grow tax-free for the benefit of your educational superstar, and help defer and offset educational costs and expenses. The lifetime amounts and the estate tax or gift tax amounts are being increased. This year they're at 11.18 million per person. In 2019 they're going to be raised to $11.4 million. And then finally, if you're over the age of 70 and a half, you can consider a qualified charitable deduction and make a gift directly from your retirement account. Some final thoughts on planning after the tax return. If you need some extra money to pay bills or help someone, please pay attention to where you take your money from. Review your drawdown strategies. It may make sense to withdraw from your IRA or 401k, and it may not make sense. These are things that you can review in terms of where you fall on the taxation brackets and what makes the most sense for your situation. We always try to help clients with that. On the horizon, we have a potential new law, the Secure Act. It passed the House in 2018 and is awaiting the approval of the Senate and the President. It looks reasonably probable that it's going to pass in 2019, but of course nobody has a crystal ball. The key changes that we'll see under the Secure Act is that required minimum distributions will be deferred. So this will be good for a number of our seniors. You will not have to start taking RMDs starting at 70 and a half, but you can wait till age 72. Next thing is they lift the limits on contributions for to IRAs, so there's no limit on them anymore. And then finally, some of the bad news is the retirement accounts must be withdrawn primarily within 10 years of owner's death. Right now, you can leave an inherited IRA or 401k, and it converts to an inherited IRA to a beneficiary, and the withdrawal schedule is calculated on their lifetime. This is going to be capped at 10 years. So where do we go from here? One of the things that we enjoy doing for our clients is we enjoy sitting down and reviewing their changes with them regularly. What can you expect with us if you're one of our clients? If you're a financial advising client, one is constant communication. We try to keep you informed and make sure we know what's going on with your situation. Frequent discussions, and the knowledge that we are continually reviewing economic, tax, estate, and investment issues for our clients. If you email me much or call me, you'll find from time to time that I'm off at a seminar because I'm out learning this stuff. I generally incur more than 36 hours of continuing education a year so that I can keep you guys safe and informed. That's what we're here for.